Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Dugal. Let's get straight to the headlines. Indian markets snap a 7-day losing streak to trade marginally in the green. Cement, pharma stocks on the upside.
Dollar strength takes the rupee to a fresh 6-month low. The Indian currency drops to its lowest level since March 14.
Economists lower India's FY18 GDP targets to 6.8% according to a survey conducted by Bloomberg News.
The government may hike gas prices for the first time in 3 years, shows a Bloomberg survey.
And Lupin is looking to acquire assets in the women healthcare space, says CFO Ramesh Swaminathan in an interview to Bloomberg Quint. Adds that $1 billion in M&A war chest is ready with the company.
Markets, they've remained subdued after 7 days of weakness. There seems to be not too much display of underlying confidence. Neeraj is here to take a closer look at some of those stocks and what they're doing. Neeraj, what do you think is going on?
Well, it's a welcome move today, Harsha, because every single day we've started off sedate and then only fallen off. And concentrated fall, because it's only India that was doing so. Today's session, expiry day, wherein the volumes and volatility should ideally have been high. Both of them have come off. Volumes compared to normal expiry slightly lower. Volatility, India VIX has come off from the 14-odd levels as well. But yeah, trading flat. Some interesting moves. One, cement has made a bit of a bounce. Probably reckon a dead cat bounce because they've been sold out so much for the last 1 month. I think the stocks had lost significantly. Maybe this is a bit of a bounce that is coming in. We could find no fundamental reason, quite frankly. If anything, petcoke prices have only gone up and that should add to pressure. But Ambuja, ACC, Sanghi and a bunch of other stocks are doing rather well. OMCs continue to bleed though. And I think if you just look at the last 1 month, by virtue of this crude price hike or otherwise, but OMCs have lost anywhere between 13 to 16% in today's session to almost all of these three are down. HPCL down about 13%, BPCL is down about 13 or 14% over the last 1 month as well. So it's not looked a very pretty picture for OMCs as well. And the key is that the bank nifty continues to stay weak. For the longest time, I think all option writers were suggesting that 24,000 remains a key level for expiry.
Sure.
We broke that yesterday and we subbed that today as well. Let's see if indeed the next 2 hours and the last half an hour throws up some interesting trends there.
Hold the thought. Here's a technical chart from the Bloomberg terminal just to illustrate the bearish signal at the moment. India's Nifty index has almost formed a so-called double top pattern after falling about 4.5% through Wednesday from its record high of 10,178 on September 19th. This is a chart by Jay Bala, a Singapore-based chief markets technician at cashthechaos.com. And he says the support is somewhere at 96.50. Neeraj, any thoughts on this?
So, well, three fundamental guests, Harsha, the last 3 days have said that if we'll fall till 9,500. The poll that we did today as well, we put out this morning on BloombergQuint.com. By the way, you can go to the site and read that poll as well. That suggests that majority of the people believe that the downside is 100 points to 200 points. The large portion was 200 points, and 200 points from here takes us to the levels that the chart is probably indicating as well.
Interesting. Let me throw in another chart, and this is what brokerages are saying. And brokerages have actually raised their estimates for companies in the Nifty 50 to a record as the government considers a stimulus. The problem is profits haven't actually caught up with these optimistic projections. Here's an interesting one. Take a look at that chart. The white, and if I can zoom in a little bit and to explain this to you, the white line is the projection. They've actually moved up considerably for the market. And the lower line is that the fact that profits have really not caught up since the run up to the elections. This is again is a chart. I mean, you know, how reality and expectations has always been a yawning gap.
And how people still continue to remain in the hope trade, right? Maybe this is an indication of that, because every year for the last 2 years, I think this brings out that we start the year with extremely high earnings expectations, only to fall down. And now, for the first time, we've heard people say that, hey, while this year is gone any which ways, some bit of earnings expectations of FY19 is also being scaled back. Now, even those could be proven wrong, but the limited point I think this chart shows really well is that while sell side keeps on raising the rates and the targets and the earnings estimates, yeah, you're right, somehow earnings are not catching up.
They sort of have to do that, right? They keep projecting these numbers on the indices. You have to then give a reason to actually meet those numbers. But the other point, and I think this is one hope which is probably partially realistic, is that in all of this, the money that's flowing into mutual funds, Nupur Acharya of Bloomberg News is joining us to talk about this. The money that's flowing into Indian mutual funds will come in as the savior this time around because, you know, that money is there. It has to be invested somewhere.
Obviously, Indian market is a study in contrasts.
Yes.
So, despite what the FIIs are doing, domestic investors have a different path to tread. And we've seen that even yesterday, when it capped its longest, losing streak since December 2016, we saw domestic investors buying. They bought about $280 odd million of stocks, which helped support the market. And this trend, mind you, is likely to continue given what the flows are there in mutual funds.
Okay, throw some numbers on what the foreign guys are doing.
So foreign guys have been net sellers, and this would be second consecutive month of their net selling. So they've already sold $1 billion in August, and they're headed for a similar kind of number for this month as well. But the FIIs, we have to understand that India is in a larger pie of emerging markets. So they look at India along with all the emerging markets. It's not that India is singled out. And there are obviously a lot of macro concerns, and you just can't wish them away. So they have their own reasons. And rupee, mind you, has been falling a lot, and at a mid-March low kind of level. So that is also a big concern for them. There are concerns on growth. There are concerns about fiscal deficit as well.
Can I just quick number out there though, Harsha? I think what he's trying to say as well, I was looking at these flows yesterday. So quarter to date, $2.3 billion, if I'm not wrong, in India.
That's right.
Taiwan, South Korea and Indonesia in the same bucket. Almost $2 billion a piece. Actually, India is, in that club. So it's probably not just India specific. However, that doesn't take away the fact that the money has been pulled out.
But here's another view. Morgan Stanley says, the party has just begun. Modi government's digitization drive will translate into a multi-trillion-dollar opportunity for investors, also believes Morgan Stanley. In a conversation with Bloomberg's David Inglis and Angie Lau, Anil Agarwal, head of Asia Financial Research at Morgan Stanley, actually says the Sensex will cross the 1 lakh level by 2027. Listen.
In the next 10 years, India will be the third largest economy in the world with a GDP of $6 trillion. Indian equity markets will be one of the top 5 with a market cap of $6.1 trillion. And Indian financial services sector, because a lot of people keep talking about fintech will destroy financial services, my view is that Indian financial services sector, which has a market cap of about $450 billion right now, will likely be a market cap of $1.85 trillion as the third largest market. So near term, there is pressure, clearly, because things are changing and people will take time to adapt themselves to the changes. But if somebody can take a 3, 5, 10-year view, this is an absolutely, as we say here, it's a multi-trillion-dollar opportunity.
And that drives, and I'm just at the bottom of our screens, there you go, that's 100,000, that's one of the targets that you have. Is that a base case?
For the market, for the base case,
by 2027. Bull case is 130,000?
Yes.
All right, so what do I buy? Do I buy the usual suspects, if you will? What sectors do I go overweight and just go out, come back in 10 years and hopefully find a pot of gold?
So what we are doing here, David, is that the two sectors which we think are clearly levered to this theme are financials, because, as I said, the credit opportunity is huge. So we're expecting credit growth to be about 13% a year for the next 10 years, which on a compounded basis is quite a big number. And what within the sectors we are talking about is, one is MSME, as I discussed earlier. The other one is consumer sector, where we think that the compounding would be about 16 to 17%. So the consumption-linked names are going to do very well because leverage is going to increase. We expect the consumption basket of the individuals to change, and just nominal GDP increase will help consumption. So the two sectors which we are saying investors should look at buying are financials and consumer. Right now, if you look at the combined market weight of these two sectors in the index, it's about 47%. We are saying in 10 years that number goes to about 63%. So if I were to buy and forget about it for 10 years, these are the two sectors I'll buy and just go home and sleep.
The digitization of consumers, the consumer sector is really interesting in India. Everybody wants to get in on that story right now. How is that like the Flipkarts and the Amazons and the e-commerce really? Is that what you view as triggering potential growth here?
No, so that's, again, that in our view. So what we are also saying in this report is that if you look at e-commerce sales right now, the GMVs, it's about $15 billion in India. Over the next 10 years, our view is that this number will increase to $200 billion. And the reason is two. One is that right now, these e-commerce companies, one of the problems is that a lot of payments happen on cash on delivery basis, so there's a lot of leakage. And now as digital payment options pick up, that problem is circumvented. And second is that the suppliers who supply products into that ecosystem, they don't get credit, which is the MSME. So now there'll be credit flowing into that ecosystem, so there'll be more suppliers. So e-commerce will do very well. which will also help the consumption sector. But the big driver here, again, the killer app in this report is credit, which is that there will be credit flow into the right sectors of the economy.
The luxury of long-term forecasting. Back to the here and now, and this time for the currency and the bond markets, both seeing action recently. Let's start with the bond markets because we do have the second half borrowing calendar to be announced today, so worth checking in on what bonds are doing. Bonds have had a bruising month as well. Yields have been inching higher and continue to be on the upside, but although off peaks. The rupee this morning did fall further. It had broken some important technical levels in trade yesterday, and this morning that pushed it down further. 66.10 to 66.20 is what people are saying that the rupee may fall to, given that the Reserve Bank of India didn't come in any big way to support a level. They of course say they don't support levels in any case, but sometimes they do tend to come in at crucial levels. This time they didn't. Fiscal data commentary remains key, and like I mentioned, the second half borrowing calendar is important to focus on as well. Just a brief mention at this stage when the markets tend to get nervous that India has an adequate pool of forex reserves. In fact, we have record high forex reserves. 403 billion is what the forex reserves stand at. If you look at the adequacy of reserves, about 11 months of cover in terms of imports. But a flip side to that is that given that the pool of foreign portfolio investments has been rising, that portfolio is now at 120% of reserves. So that could be one counterpoint to the fact that reserves are adequate, but still that would only come into play if you see a very sharp sort of global turn in the mood, which would then lead to outflows.
Interesting that. That's interesting moves taking place in both the bond and currency markets. But let's talk about commodities now. Gold has fallen below the 50-day moving average for the first time in 2 months. Pradeep is standing by to tell us what's going on in gold and rest of the commodity markets. What's going on? You've seen dollar gaining strength. You've seen gold lose a bit of its momentum. What's the sense in the market?
So first of all, of course, because the gold normally moves against the dollar, so if dollar is now gaining strength, gold is correcting, that's no surprise. But if you look at the price movement, the gold has actually corrected from roughly 1350 odd levels, the level that we saw because of the global uncertainties and the geopolitical tension with North Korea. So probably market has now kind of forgotten it, and money is moving out of gold. Today we saw a level of 1280 or so a couple of minutes back when I checked. So clearly there is sharp profit booking in gold now that we can see clearly, and that reminds me of a story that we had done in the beginning of September, that if you look at the seasonal trend, gold has a habit of peaking in September. So have we really seen a peak? If dollar really appreciates further, maybe yes, we have. What
about the domestic market, Pradeep? This is festive season, so are we seeing any sort of anomalies in that trend locally? So
what happens is, the rupee is kind of dominating the local prices, and if you look at the delta, so the impact of 1% appreciation in rupee would be stronger than the entire correction in gold that we have seen so far. So domestic investor, of course, will not really benefit from the lower gold prices if you're buying in Navratri or you intend to buy on Dhanteras or Diwali. So that's okay. That's definitely a problem for us. But for a buyer in dollar, the gold is getting cheaper, and the trend is reversing. So maybe even in rupee, if you want to wait, it's possible that if the gold corrects more, you'll be able to buy cheaper, maybe.
Okay, let's get another voice in. Gavin Wendt, founding director and senior resource analyst at MindLife, joins us on the conversation. Gavin, thank you so much indeed. What do you make of this fall in gold prices? It's fallen below the 50-day moving average. Is this about dollar gaining ground, or is this about inherent weakness in gold prices?
I think it's more to do with the commentary coming from the Federal Reserve in the US. We've seen so far during 2017 the Fed adopting a more dovish approach, where the market had been expecting at the beginning of the year that we would see significant movement on interest rates. And then during the middle part of 2017, the Fed's commentary seemed quite cautious. What they've done just recently is they've restated their position that they would like to increase interest rates, probably one more before the end of 2017, and then a series of rate rises during 2018. And the initial market response is typically that when rates are rising, it's bad for the gold price. I don't think it's so much to do with the US dollar. I don't think we're going to see a rally in the US dollar, but in the near term, I think gold price upside is going to be capped. And I think, as you just mentioned earlier in your discussion, the last quarter of the year, typically, of the calendar year, is typically not a good period for gold prices. Now, the last 3 years, or the last 2 years, we've seen the Fed raise interest rates, not by a large amount, a small amount. We're likely to see them do that again. So that's going to cap gold prices. But I think the important thing to bear in mind with respect to gold is that although interest rates are increasing, some of the best periods of performance for the gold price historically over the last 50 years have occurred when the interest rate is actually rising in the United States. And I think that's something that people aren't necessarily aware of. So it's not the interest rate increases per se, it's the real rate of interest rate rises. And in the United States, although they are looking to put up interest rates, the rate of inflation is actually higher than interest rates. And during periods in history over the last 50 years where the rate of inflation has been above the underlying interest rate, we've actually seen gold do very well. And don't forget that the United States has got $20 trillion worth of debt. If they are to put interest rates up to anywhere near normal levels, it's a big question mark over how they're going to service that debt. So the bottom line is I don't think that we'll see significant interest rate rises simply because of the negative impact it would have on the US economy.
Gavin, that's a very interesting point that you raise. Could it perhaps be because gold at some level is considered a hedge against inflation, but in a scenario like now, where actually inflation is underperforming most expectations, perhaps that won't hold true then you could have an expectation of a slightly more muted rise in gold, even if inflation is on the uptrend and rates are on the uptrend?
Look, you're right, and I think the performance of gold during 2017 has reflected that. I mean, we've had this debate around inflation. Is inflation emerging in the United States? Is it not? I think a lot of people believe that the official inflation statistics in the US understate the real level of inflation. I think people living in the US say, hey, inflation is a lot higher. We see prices going up a lot higher, a lot more quickly than what the official inflation rate is. And so I think that's true. And I think the other important point to bear in mind is the political uncertainty of Korea, all of that sort of stuff. And when you've got the huge level of debt in the United States, I mean, if we go back to the GFC, I mean, the thing that caused the GFC was the low interest rates and the huge level of debt that was out there. The solution to the crisis that was implemented by the Federal Reserve was more of the same. So we've seen an escalation in the amount of debt in the US economy. If you ask the average man on the street in the United States, real wages haven't grown. So it's certainly been the fat cats at the top that have benefited. And so I have a big question mark over the robustness, the breadth of the US recovery, particularly when you've got this huge amount of debt there. So I still think that gold is going to be bought as a hedge against future economic uncertainty.
All right, Gavin, interesting thoughts there. Thanks so much. Appreciate you taking the time to join us. Just one quick last macro word before we get into more corporate news, and that is that we've got economists starting to cut their estimates for GDP growth for the current fiscal. Demonetization is one of the things that seems to be impacting those growth targets. So the numbers on your screen, what the new targets are and what the earlier targets were. So you're looking at about 6.8% growth versus the earlier target of 7.3. The question now to watch for, and this will get answered next week, is whether the Reserve Bank of India also cuts its forecast.
All right, the government's advice to states asking them to bar tobacco stores from selling chips and biscuits will hurt some of the country's largest FMCG companies, be it ITC, which uses the same distribution channels to sell cigarettes, and other FMCG companies like PepsiCo, who sell a lot of their small products at small cigarette stores. A market research survey done by Deutsche Bank has pegged the impact of 20 to 50% on biscuits, snacks and confectioneries. Joining us to discuss this and a little more on implications of this is Kaustubh Pavaskar from Sharekhan. Kaustubh, thank you so much indeed for joining us. What do you think this is going to, how is it going to impact the large FMCG players?
So I don't think it will have a bigger impact on the large FMCG players because I think if you consider the overall FMCG industry, I think 6 to 8% of the revenues is coming from this small retail, pan retail shops or cigarette shops, which is currently equivalent to what the modern retail is contributing to their overall sales. But I believe large players have the capacity, to diverge it to small to change the trade channel, and it will be largely sold again through small retailers, or they will sell it through other channels. But I think for small players, especially for the players who are selling more of the confectionery items, or savory snacks or chips, I think for them it would be a difficult scenario, because I think confectionery items or savory snacks, chips, I think that contributes more than 50% of this retail shops non-FMCG sales. Non-cigarette sales. So I think that small players will have a larger impact.
The players that come to your mind that you're closely watching, which might be impacted by this move?
I think the savory snacks or snack players like DFM Foods, or the company which will be coming on board like Pratap Snacks, or there are other small players which are non-listed like Haldiram, or who normally sell their products through these channels. See, the impact would be largely on the products which are of low price packs, like 5 rupee pack. So for that matter, it might be a biscuit of 5 rupee pack, or a savory snack of 5 rupee pack. So or confectionery, 1 rupee, 2 rupee kind of a product. I think there will be the larger impact. I don't think large players, will have much of the impact, because they have their distribution in place. So if not this channel, they will definitely pass it on to some other channels like small retail shops or modern trade, where they would see sales coming back on track. So it will be initial hiccup for large players, but over the period of time they will be able to see sales coming back online.
You don't expect guys like Britannia, even if they're selling smaller packs through these outlets, to be impacted hugely?
Obviously, initially, as I said, initially there will be impact, but I don't think Britannia has is usually leverage on this channel. I think it is largely sold through small retail shops, or through retail shops, modern trade, and other channels. So it already has its distribution in place. I think its revenues coming from this particular channel would be less. So there would be initial impact on the revenues, but over the period of time, I think that will get mitigated through selling products through other channels.
Okay, we'll leave it there. Thank you, Kaustubh, for joining us. That's a view coming in from what this move may mean for the large guys. He says the large guys won't be impacted. It might be the medium size and the smaller players who may have to find other ways of distribution.
It's also very tough to implement something like this.
Yeah, what would you do for smaller towns?
Store to Kirana store to figure this out, but
And India is full of these little mom and pop shows. Right?
Exactly.
Yeah.
Well, we'll see how that plays out. Meantime, one of India's largest pharmaceutical firms, Lupin, plans to get that much bigger. The drug maker is scouting for acquisitions in the women's healthcare space. In a conversation with Menka Doshi earlier today, CFO Ramesh Swaminathan said that Lupin can leverage its balance sheet to borrow up to $1 billion and fund acquisitions. Listen in.
We have always professed our interest in women's health as well as the pediatric space. That's because we've got a franchise which has been around for some time. We already have a couple of products in both categories. Suprax, of course, was our anchor product in the pediatric space some time ago. It's come down substantially. But having said that, we are looking around for assets in the women's health space, and there are quite a few there in the market. Having said that, the sweet spot for us would be between $150 to $250 million per tranche, and we could do multiple tranches of this.
Per tranche, explain that to me. Sorry.
So potentially one molecule, we could.
Okay, so you'd be buying products, not the companies themselves.
It could be companies. It could be it could be a product. It could be.
So how much have you put aside, let's say, for M&A, or how much have you earmarked?
If you look at our balance sheet, I think we've got capacity to borrow about $1 billion more. But that's so. And
so you started with $150 to $200 million, and you just told us that you have the ability to leverage $1 billion.
We could certainly do that, but having said that, it's not as I'm going to expend that entire amount in one tranche. It's going to be, as I said, across multiple tranches and over time.
So you'd be comfortable to spend about $1 billion on an inorganic strategy to be able to build out the complex and specialty side of the business.
For sure.
That's
having
a fair
said
way.
That, there is also continuous accruals. A lot of the pipeline is still rich, so I think the cash flows are pretty steady.
ICICI Bank has introduced a new scheme under which it will offer cash back on your EMI payments. Sounds bizarre? Well, it is. Bigger question here is what is driving this and what led to the scheme or product being announced? Is it a fear of prepayments? Is it an excessively competitive market where there are 100 firms offering home loans? Vishnath Nair is joining us on the phone lines. Vishnath, I know you're waiting to interact with the management at ICICI, but what are we picking up on what drove this product?
Well, yeah, what we understand, we've had this interaction with the management already. What they seem to be saying is that they want to capitalize on the people's interest in buying homes or other discretionary spending during the festival season, and that's probably why they're pushing for this product at this point in time. This product is currently only available to the new customers and not people who either transfer their loans or have existing home loans with ICICI Bank. What the bank is saying is that it already has the highest home loan portfolio among private sector banks, and it only hopes to grow this further, especially using this product.
All right, Vishnath, we'll wait for you to come back to file that story, and you'll be able to catch it on BloombergQuint.com later today.
The government may increase domestic natural gas prices for the first time in nearly 3 years. That's according to a survey of analysts and industry participants done by Bloomberg. The move could provide much needed relief to producers who are struggling to recover costs. Saket Sundari of Bloomberg, who's done this survey, joins us in our studio. Saket, what's the logic behind this and what kind of hike is expected?
So this is something that the government does every 6 months. So gas prices are revised every 6 months based on a formula which is again based on several benchmarks in other countries like US and Canada. The next one is due on October 1st. And ever since we started this price revision, this is the first time probably in 3 years that we'll see an increase of about 13% from the current price of 2.48 per MMBTU that these companies are getting. This is not, I mean, there's no reason driving this. It's just, price revision that's done periodically by the government.
Okay, so what is the price hike you said again?
From 2.48, we expect it to rise to about $2.8 per MMBTU.
Does this anyway change the dynamics of the market?
It does help a bit, not too much, but it does help because these companies right now are making losses on producing gas, especially ONGC, which is the largest producer of gas in India. It accounts for almost 3/4 of what the entire country produces. So their average cost of production is about $3.50. So to that extent, their losses will be reduced.
Thank you, Saket, for that.
Right. Generali, a unit of Warren Buffett's Berkshire Hathaway, won a license to open an India office in May. The unit plans to expand in the health and life insurance space as well as the property and casualty cover segment. Bhuma Srivastav of Bloomberg News has been tracking this, joins us with more details on that. Bhuma, what are you picking up on their plans ahead?
So basically there's a rush among foreign reinsurers such as Generali to come to India because it is the fastest growing reinsurance market in the world. That's basically what's luring them in. And India relaxed regulations, opened the market up 2 years back. So now they're all here. And Generali is the latest one to get the license in May and open a branch thereafter.
So they pretty much provide a full suite of products?
Not a full suite. They have a focus on life and health. That's a predominant business. They're also looking to expand in property and casualty cover because that's a new area for them. They're still assessing risk and how to go about it. So that's largely area of focus. They want to spread themselves thin, but these 4 areas are, the focus to begin with.
What kind of growth are they looking at and who would be competition for them?
So India reinsurance market grew at CAGR of 26% in the last 5 years and it's going to grow at about 9% in the next 5. Generally, India chief did not want to give a profit projection, market share growth, etc. for him, but that's how the market at large is growing. The second thing you asked about was how...
Who are the other players in the market?
A lot of competition for them actually. After the market opened up, I think companies like Munich Re, Swiss Re, Lloyds of London, a bunch of them have already come to India, opened offices. So Generali is probably not among the early birds here.
All right. Bhuma, thanks so much for that. I think that's pretty much a wrap on the show today.
Thank you so much for joining us on Power Lunch.
Are we live?